Good morning, good evening, and good afternoon, everybody. Hope everybody's having a fantastic day, fantastic week. It has been a while since we've been on this show, and I tell you, I am excited. I have been so excited. So sad we missed last week. Today, we're going to be talking about a quick market review. All eyes are on the Fed. The Fed, in the hot seat, pretty much. We're going to be talking about the portfolio, still at that 91% win rate, which is pretty daggum good. We're going to talk about a couple recent trades that we have, maybe. Not sure if we have any outstanding. It's been a little while. Then we're going to go through a quick current trade, and then we're going to go through some of your stocks. So if you have any questions, any comments, any stocks at all out there that you want Mike to look at, go ahead and put those in the chat. Let's go ahead and get to the real reason why you are here, Mr. Mike Wade. How are you doing, sir?
Good morning. I'm excited. March Madness starts today. Woohoo!
Yes. Best time of the year.
Oh, it's the best sports of the year, man. It's just awesome. Yeah, I love it. I've got Duke and Florida final two.
Nice.
Going a little bit of a ways too, there, buddy.
Yeah, I hope so. I hope some Clemson pulls a couple of wins. Got a tough test today, but only gets tougher from here.
Yeah, exactly. They'll win. They'll get to a few rounds for sure.
Yeah.
Yeah, you mentioned the Fed is in the hot seat. Yeah, let's put up that graphic, and you can see how hot it is for Jerome Powell, who's the Fed chair. I mean, would you want his job?
No, not at all.
He's being glared at, and with lots of pressure being applied to the Fed from the White House. Here's how it works. The Fed cuts rates when let me do it the other way around. This is more clear. The Fed will cut rates if the markets, if inflation is starting to become a problem. All right. So the idea is that no, I'm sorry, you got it wrong. See, I just the other thing, Ryan, that happened here is when I got back to Costa Rica on Monday. They don't change their clocks, so for me it's like 7 a.m, and my brain's a little foggy. So let me get this going. And so the Fed uses rate cuts to control the economy. If the economy is getting too hot, then they raise rates, and if the economy is getting too weak, they cut rates. And the idea is to control spending, the consumer pocketbook basically, and slow down consumer spending, increase consumer spending. And so the problem we have is that Trump's tariff plans, it's literally a tariff war. And you're going to see here in a minute when we look at the SPY chart that there's been a tremendous amount of volatility, mostly to the downside. And so inflation is more likely to increase. And so what the Fed would normally do to curb inflation is raise rates. And so this is like a perfect storm of, oh my God, this thing could just explode into maybe recession. It's not the right thing to do with inflationary risks on the horizon. And it's just so much pressure on the markets. It's something I've never seen before. And if we take a look at the SPYs, this is the ETF that tracks the S&P 500. Ryan, I went on my cruise on this day, and I got onto the cruise ship, and all of a sudden the markets went from all-time highs to a major down leg, and then it continued. The volume on the downtrend increased, and then as it started to bounce, the volume has decreased. The only reason we bounced yesterday, the Fed left rates alone. They had their rate announcement yesterday. And then Powell did say that we still have the possibility of 2 rate cuts by the end of the year. And the markets responded positively to that. Everybody, including me, was expecting them to say less probable on rate cuts, but they still held that rate cuts are still on the horizon. All right. And so that has created a little bit of bullishness here. We are still below the 200-day moving average. And so when I'm looking at this chart, here's what I think, and I could be wrong. Sometimes I am. Just ask my ex-wife. I'm not buying this bounce. All right, here was an annual low there, pretty much. We bounced right off 550. Look at support resistance, round number 550. The low of this day at 550. You must get behind the power of support and resistance. It is awesome. So that is a proof in the pudding that these round numbers are really important. All right, so we get our bounce. We're still below the 200-day average. We came below the 200-day average on big volume. So volume is another way to think of volume is institutional conviction. All right. So the conviction rose, institutional conviction rose as the market set about a 10% correction. And then as the little bounce happens here, the conviction has dropped. So it tells me that there's still a high possibility that we're going to see another down leg, perhaps even below 550. If we breach 550, expect 540. This is a rough rule of thumb. The only way I'm going to go bullish on this market or have a bullish opinion is if the SPYs end up closing above the 200-day average, which is this blue line right here. Now, one thing we can expect is the unexpected. Expect the unexpected market volatility. We are one Trump announcement that he's dropped the tariffs on Mexico. He hasn't said that, but he has in the past, or new tariffs, higher tariffs. You know what I heard the other week, Ryan? And this is a little bit disconcerting, is that Trump plans to put a 200% tariff on Veuve Clicquot, French champagne, and that's going to triple the price of my favorite champagne, which is already pretty expensive.
Oh, so no. That's the real travesty here.
That's what I really care about. Veuve Clicquot. Oh man. Anyway, volatility, and just be ready. Be very careful trading any direction. And I would say unless it's down, if we see a nice close below 550 and the volume starts picking up again, watch out below. And that's, to me, based on what I know about the economy, about interest rates in the Fed and markets, is that, to me, there's more downside risk than upside potential. But let's use technicals. So I would say expect choppy sideways until we close below 550. And then unless if the markets close above, the SPYs close above the 200, then I might have an intermediate short-term bullish prognosis. All right, so volatility for stock traders can be bad. It is bad for us as option traders, and the way that we snipe with credit spreads, we can sort of stay on the sidelines a bit and absolve ourselves to some degree, not completely, but reduce the exposure to volatility. So we're going to be doing that today. I've got two companies I'm looking at, and as Ryan said earlier, if you have any stocks you'd like me to look at, please post them in the chat box, and Ryan will bring them forward. All right, we have 7 minutes before the market opens, and because we haven't been together for very long, for a while, let's go right to our performance, Ryan. We had a 16 trade win streak that was very enthusiastically interrupted by the trade we put on Shake Shack. All right, but where we are, we took that hit, and we're operating at 9.81% average profit over 5 days. 91% of our trades have been winners since we have started. And yes, you see that largest loss there on the right column, halfway down, says negative 300. That was Shake Shack. That just happened, and that's what interrupted our win streak. Now, we had before the Shake Shack trade, I think we're up around 11% plus average profit. So the point is that over time, this system tends to normalize at about 10% every 7 days. So we're right where we're supposed to be. We took a big hit. We had lots of winners, and that's the sniping approach. And with 5 minutes to go, let's talk about Our potential trade for today. Ryan, there's a company that just announced earnings, and it's called Jabil Circuits. Jabil jumps on raised annual revenue outlook. Q2 results beat. They beat and they raised. Jabil raises 2025 profit revenue forecast on data center demand. So the stock, what I call a bifecta, had a beat on their earnings and they raised. The bearish bifecta would be they missed on their earnings expectations and they lowered guidance. So this is the bifecta. Now, what I would also say in this particular environment that we're in now, the volatile, sketchy environment, is to be more conservative, and I would say require that a stock have a bifecta before you even consider it. We'll see mixed results. They beat on sales, they missed on EPS, and they raised guidance. So if it's murky and it's not totally clear one way, then just stay out until we figure out what this market's going to do. All right, so with that, let's go take a look at a chart on Jabil. I'm using the Hub software, which is really a beautiful charting package. Has a lot of other things besides charting. But if you're interested, you can go to Hub with 2 B's, hubb.com, and you can check it out. So here's Jabil's chart. And what I love, if you see the chart here, it looks a lot like, it looks a lot like the markets, right? It looks a lot like the SPY. It's come down and it has bounced. What I love about this chart now is that we had big volume yesterday before earnings. And now if I go to a Thinkorswim chart here, this is a simulated platform that I use to show you how to place these trades. The stock pre-market is at 145 by 148 or so. So the stock has risen at least 10 points. And we go back to the Hub chart here. So that puts the stock up here right around 150. Okay? So let me show you the one issue we have. And that is that the granularity of expirations is only monthly. So we can't do a one-day trade. We could, but there won't be any money. Ideally, we want to see 14 days, 2 weeks. That's the sweet spot. 28 days is beyond the sniper rules. Okay, so I'm going to show you a different type of credit spread that I'd like you to paper trade. Those of you that know credit spreads, you have more facility with credit spreads, may choose to take it. You take it how you want, but I would say that I wouldn't want to be in this trade for 28 days. That's a month during which more volatility can happen. So this is, again, the last month or so, this is what the stock has done. Now the downtrend has been interrupted with great enthusiasm, and so that leads me to believe that this stock is more immune to coming below the 200. So even during the correction, the stock remained above the 200. It also, notice, bounced off of 130. Look at that. What? Look left. Resistance. Support became support. Support held. So we've got a support level at 130, and then we have the 200. So the only, and I didn't find any other setups that had less than 28 days. There's another one on 5 we'll take a look at. But this one I think would be a good credit spread, a longer term one. And because we're going longer term, here's what I think could be reasonable on this one. All right. So we could say we want to sell, let me back up. Let's put our line in the sand at 125. All right. So the idea of this, the stock's almost at 150, and that is also resistance. We could see a pullback from 150. We're going to watch the stock open. There it opened at 146.30. Let's let it breathe a little bit and see what it's doing. See, already it's starting to come down. So we want to be a little bit careful. Let's let that breathe for a bit. So here's the idea: we could place a 1 month credit spread that we're going to manage in a similar way, and we're going to say, well, normally what we say is close the trade out for a managed loss if the stock closes below your short strike, which corresponds to your line in the sand. Now, what we could do instead, just to really keep our risk contained further, this is the only way I would trade this one. I would say if Jabil closes below the 200, then get out of your credit spread at 125. All right, so we're going to take an early exit. It's the only way to do this one because of the market downside risk. So that's what I'm going to propose we do. I would say paper trade this. This is the kind of trade that's outside of the sniper scope, the rules and the rule book that you have, the guidebook. So, but I think it's a nice educational example. So let's treat this one as an educational example, and then we'll go take a look at some of the stocks you're looking at. All right. So if you have questions about that, please ask them, and I will answer. All right. So I want to sell at 125, making money anywhere above 125. If Jabil continues up, we make money. If it goes sideways, we make money. If it drops and stays above 125, we make money. The question is, how much can we make? So let's pop right in here. I'm in a simulated environment, by the way. This is Thinkorswim's simulated trading environment. I'm not taking this trade. I don't take the trades. And I want to sell at 125. These are the April 17, 28-day options. Selling the 125, buying the 120, and I can see 35 cents credit there. All right. That's what the mid price is. The spread width is $5, and I don't take these unless I can get at least 10% of the spread width. So that's what I want. I'm not going to take any less. I can put a line in the water, or a hook in the water, to catch this at 50 cents credit. All right, let me show you what this looks like before I hit send. And so this is exactly what I'm doing here. Sell to open, the Jabil, April 17, 125 put, buy to open, everything's the same except the 120 put. That generates a credit. Right now it shows 35 cents, but we want 50. We're going to use a GTC order and let that sit. Actually, let me retract that. You can use GTCs to enter, but you must cancel them by the end of the day. Now, GTCs, good till cancels, can facilitate fills. So that's why I do it. And then you manage the trade. If the stock closes less than the 200-day average in this case, then we would close the trade. I hesitate to, let me do it here. So if the stock closes less than the 200-day moving average, then we are out. All right, let me place this trade. Mid price still remains at 35 cents. Slippage is pretty wide on this one in the morning. It will typically tighten by towards the lunch, as we approach lunch. Let's go ahead and put it in and see if we get a fill. So there it is. That's the order. It's waiting. It's like a hook. We want 50. They're only offering 35. Give me 50 or give me nothing. We're going to let this trade come to us. So Ryan, that's what I have. Let's see if do we have any student trades that we could look at?
Not seeing any quite yet. If y'all have any questions, be sure to put them in the chat.
Yeah, this is more of an educational example. I didn't say this in the beginning, Ryan, but we are in the cold spot of earnings. There just aren't that many of them right now. There are some. There's always some, but not as many as we normally like to see.
Gotcha.
All right, I do have 5 here, 5 networks. I like this one, but I don't love it for a few reasons. One, the stock has been in a virtual free fall. You can see the 200-day moving average here, this blue line. sloping down, and that's a sharp slope for a 200-day moving average. Right here, the 50 crosses below that very sharply downward sloping 200-day moving average. The red line is the 50. That's a bearish cross. So the overall complexion of the stock is bearish. Yes, Five Below came out with some pretty good earnings. Let me show you what they look like. Five Below was earnings and revenue beat. So they beat. And their next quarter sales guidance is optimistic. All right, so that's a bifecta, right? So their outlook is improved, and they beat on their estimates, and it's got every reason to go sideways at the very least. But because we're at near bottoms, I'm just not super comfortable taking this trade for 28 days. Let me show you the expirations that are available for Five are only 28 days. So think of this. We could consider a longer term credit and sell down here at 70. But that's a month. We've got a month of potential market correction. And that, and Five Below has come down with the market. So we could very easily see this thing fade, and then the stock set lower lows, and that would quite likely happen if the S&P 500 resumed its corrective wave. So this is not, in my mind, a really good trade. Now, if Jabil was above the 200, then I would consider it. So I would say stay out of that one for those reasons. Ryan, I think today is going to be more education than live trades. I just don't see any of that I love.
Yeah, a couple people were saying that there's nothing else showing from the markets right now. So,
yeah. Well, let me show you one other sort of way you can trade. This is another type of credit spread that I like. And I like these in correcting markets. So let me show you the SPYs again. And here's where we are. We were a little bit down at the open. Actually, no, we opened higher. The futures were down, but we opened higher, and we're trading right around 465. So the markets have, they have dropped, but they're rising again. So I think we got some strong resistance up here at top of these bars here, 570. So we got resistance there. Let me draw that because it's important to what I want to share with you. All right, so that's 570. That's resistance. So is the 200. So is 580. Look left. Look left, he said. You can see support resistance at these levels. All right, look at that. 580. 580 support. 580 support resistance. Kind of dance with 580. That's resistance. 590 is resistance. 600 is resistance. You can just draw the lines if you like. And you can see that these lines are perfect guides to figure out where we might want to sell a credit spread that would make money as long as the markets don't recover. All right, so during this period here, my community, I've got a snipers community, and we were trading bear call spreads, bearish credit spreads as the market was correcting. And so far, all of them have been winners. So the idea then would be, well, decide where you want to sell. I mean, would you say that 590 would be a pretty safe place to sell a credit spread, drawing your line in the sand at 590? 580 wouldn't be bad either, but 590 is way away from 564. And for us to get into trouble, the stock would have to break through 570, break through the 200-day average, break through 580, and then 590 would be a possibility. So that's what I like to do, and I use the other market indices as well. So let's just take a look and see what's available at 590 on the SPYs. Let's just see. I'm going to go into the simulated environment here, type in SPYs, And you'll notice on the SPYs, there is great granularity. There's options that expire every day on the SPY. So using our formula, we could say, all right, let's go to April the 4th, and let's see if there's any, that's a 15-day option. Let's go to April the 4th, and let's see what's available, if anything, way up at 590. What? I'm surprised. Well, I think we have a live trade for today, buddy. And here it is. If we sold the April 4 590 calls and bought the 591s, that's $1 spread, and there's 10 cents available way the heck up here at 590. I'm digging it. I'm digging it. Oh, I got to be less enthusiastic, but you can lose on these. If the markets do recover, this could very well be a loser. But we got 10 cents available. I'm going to take it, and we're going to manage it just like we normally do. Let me see if this gets filled. So we're selling the April 4 590 calls, buying the 591 calls. I'm asking for 10 cents credit, and right now we're at mid price is right around 9.5 cents. So that will have a good shot of getting filled this morning. So let me show you what that looks like in the spreadsheet. So the symbol is SPY, and I just got it. Let me go back and check. I just got it. All right, so it just filled. See this here? We sold the April 4 SPY 590 calls for 72 cents. We bought the 591 calls, sell buy over here, for 62. Net credit on the trade is 10 cents. So that was filled. And let me go ahead and give you the rest of the order here. April 4 is the expiration, 4/4. And we sold the 590 call, and we're buying the 591 call above, and we're getting 10 cents credit. Oops, try that again, Mike. And we want to exit if the stock closes greater than 590. I'm just going to use the Excel stuff here. So that's a super high probability trade, and we are going to exit the trade for a managed loss if the stock closes greater than 590. That's this short call, our line in the sand. And just to take you to the chart and show you how awesome this is, that's way up here, and we make money anywhere below that point. Down, sideways, up, up, up. If it breaks these resistance levels, then we might have to take it off for a managed loss. Now, one other piece of information I want to give you here is there's something called the VIX. And the VIX is the Market Volatility Index. What does it measure? Well, essentially what it is the expense of options. So you can see the options, the VIX has been as high as 2750 recently. It goes higher sometimes, but we're in the high end of the range. This level here is the sort of the average, the low price on the VIX. Let me get my line drawn here. So right about there is the VIX low, and then it's got a range of up to 30. So we're kind of halfway between, but the VIX is 15 would be pretty low on the VIX as well, and we're 4 points higher, 5 points higher. So because the options are more expensive, that allows us to sell our credit spreads further away from the heat, which is exactly what we did here. So Ryan, we'll track that one. I like that one.
I dig it.
It's not as by the rule book per se, but it is another great way to use credit spreads.
Yeah, Tony's saying he just got in the trade as well.
Go, Tony! Tony probably got 11 cents versus my 10. Hey, I just mentioned the guidebook. Let's talk a little bit about it. I think most everybody here has it. But when I built this system, I've been doing this. I've been trading since '98 and teaching since 2002, I think. So I've been at this game for a long time, and over the last 20 some years or so, I was looking for a way that is a systematic, objective way to show people the world of options trading and a system of, very clear, very discrete rules to enter and exit. One of the things about trading is it's normal for us humans to trade emotionally, like gut feel or hope comes in, greed comes in. And the only way through the human mechanism of fear and greed is rules. And so this particular guide here has very discrete rules, and it will guide you through the 5-step process that we use, finding opportunities, deriving where to place your line in the sand, I call them, how to build a bullish credit spread and a bearish credit spread, how they work, how you can calculate the risk in them, and then most importantly, how to manage those trades, in particular, how to manage them for losses. So that's what the guidebook does. It's free. You can hit the link below here and order the guide. We just need your name and email address, and we'll email it to you. And then you can grab this guide and join Ryan and I Thursday mornings at 9:15, where we snipe away every week, except those weeks when we don't. Well, Ryan, that's all I got for today. Do we have any questions or other stocks to look at?
No, not seeing any in the chat right now.
All right, brother. Hey, man, go Clemson.
Oh, yeah. Go Tigers. Let's go.
Go Tigers. Go Devils.
Hopefully we can pull
Devils.
something out.
Yeah. I can't wait. It's a good time of the year, man. It's my favorite tournament time is March Madness. The games are just really good, and they're trying hard to win, and it's just a great time. So I've already got the TV going in the background. I'll watch basketball while I trade. Look at that, Ryan. You're trading, making money while watching basketball.
That's not bad. That's not a bad little life, yeah.
And I'm in Costa Rica.
And you're in Costa Rica, yeah. Not bad.
Yeah.
You look out and it's either a rainforest or a beautiful ocean.
Yeah, exactly. All right, Ryan, have a good week, buddy. And everybody else, we'll see you next week. Same bad time, same bad channel.